have some early clues on how that's going to play out. Breaking news, the Bank of Canada has cut its main interest rate by a quarter percentage point, becoming the first group of 7 central bank to provide rate relief after a rapid and aggressive increase in borrowing costs to tame inflation. Canada's central bank saying a cut was warranted because of increased confidence that inflation is moving closer to its 2% target. We're not there yet, but there have been some suggestions that we could be headed towards that level. The Bank of Canada Governor Tiff Macklem saying more rate cuts could be in the offing should inflation show further signs of slowing. Just to give you the scorecard here, the Bank of Canada lowering its target for the overnight rate to 4.75% from 5%, so a 25 basis point move. Remember, we sat at 5% for 11 months. Now, over a 16-month period that ended in July of last year, the Bank of Canada had delivered almost 5 percentage points of rate increases to pull inflation down from the peak we saw back in the summer of 2022. At that point, we were north of 8%. That sharp increase in interest rates has certainly had an impact, though, on Canadians, particularly given the levels of household debt and the mortgage cycle in this country compared to the United States. So again, the Bank of Canada has cut interest rates by 25 basis points. It is signaling more easing could come ahead. And as we have this official pivot point, we're going to have some full breaking news coverage. But I want to bring in Laura Dillon-Kane, who is just coming out of the lockup in Ottawa with more details. Laura.
Good morning. Yes, so the Bank of Canada has cut its key policy rate by 25 basis points to 4.75%, as widely expected by markets and economists in a Bloomberg survey. Now, I want to draw your attention to something really interesting in Macklem's opening remarks. Tiff Macklem's opening remarks, he'll be set to deliver at 10:30 a.m. They've been provided to media early, and he does provide significant forward guidance. So he says, you know, we don't want to jeopardize our progress by lowering rates too quickly. However, if inflation eases, it continues along an easing path, we will be able to cut rates further. So he is signaling that more cuts could be on the table, potentially in July, potentially in September, you know, though he has said there will be a gradual path. This is likely the first of several cuts to come.
Laura, thank you very much for that breaking news update on the Bank of Canada's decision. Laura Dillon-Kane joining us from Bloomberg in Ottawa. David Wolf is also joining us here in studio. He's a portfolio manager at Fidelity Investments and also previously served as an advisor to the Bank of Canada. David, it's great to have you with us as part of this breaking news coverage. What's your reaction to the Bank of Canada cutting rates?
Well, it's an exciting day. It was as anticipated, as Laura mentioned, as you mentioned. And, you know, the bank is seeing the progress on inflation that it needed to see to be comfortable in beginning the easing cycle. We talked about that today. And so long as inflation remains well behaved, the prospect is for further cuts down the line.
So if we're trying to make sense of where we go from here, the bank indicating that the easing path will be dependent on what the inflation progress looks like going forward, which they seem to be describing as likely to be uneven. To quote the governor of the Bank of Canada, Tiff Macklem, if we lower our policy interest rate too quickly, we could jeopardize the progress we've made. So if we have started a pivot, so to speak, on rates, what does that pivot look like, in your opinion?
Well, so it is a pivot in the sense that you had a direction for policy that was up for a couple of years, then a direction for policy that's flat, and now that you have a direction of policy that's down. The key question is, and it's not one that anyone can answer right now, including TIF and the Bank of Canada themselves, is how far does that need to go? We can put some parameters around it, which is to say that, as you mentioned, the current policy rate, as of 5 minutes ago, is 4.75%. The bank has talked about neutral rates being, in their opinion, somewhere around 2.75%. And that's obviously would leave, if that was the target, so to speak, another 200 basis points of easing. Now, it won't be exactly that. Time frame is unclear. And as the governor mentioned, There is going to be conditionality, so to speak, in terms of what does inflation look like, what does the economy look like, how does it react to this easing, et cetera. But that's probably the direction that we're going.
All right. If you are just joining us, we've got breaking news on the Bank of Canada cutting interest rates by 1/4 percentage point, making it the first group of 7 central bank to kick off an easing cycle. And the market is reacting to this news. We're tracking the Canadian dollar, which so far this morning, in reaction, is at session lows after that Bank of Canada rate cut. We'll continue to watch what's happening in both the currency and bond market. David Wolf, former Bank of Canada advisor and a portfolio manager at Fidelity Investments, here with us. How does the world perceive the Canadian path forward here, David? I think a lot of people have wondered what the Bank of Canada's comfort level would be on pivoting towards lower rates, especially with some uncertainty on when the U.S. Federal Reserve would be ready to make a move on rates. How are the markets going to be interpreting this, in your opinion?
Right. So a couple of things to mention. First of all, I don't think the markets are going to do very much with this. As you mentioned, bit of softness of the Canadian dollar. The cut was largely priced. I think the odds were around 4 and 5, but not entirely. So it's not surprising to see a little bit marginal further reaction to it. In terms of how the world sees that, and let's put it in context of what's happening in the U.S., which is obviously a lot more focus, not just around the world, but even in Canada, given how much our economy and our markets are driven by the U.S. So we have a very different, in my opinion, set of economic circumstances in Canada and the U.S., probably as different as I've seen in my 27 years of doing this. The U.S. has been very resilient. Productivity is going up. We think we understand why that's happening. The prospects, I think, are pretty good for a soft landing. In Canada, really what's been driving the economy is bringing home much more people in. Productivity has actually been very weak. We had another decline reported this morning for the first quarter. That's 7 declines in the past 8 quarters. That's horrible. And the Bank of Canada knows this and knows that an economy driven exclusively by people growth, so to speak, is unsustainable. So you have the conditions, I think, for pretty significant divergence between Canadian and U.S. policy. We saw the first step towards that today, and I think we'll see more in the future.
And, well, to your point, we've got the European Central Bank ready to make an announcement this week. Certainly this Bank of Canada news makes a headline for G7 nations. We did see the Swiss National Bank and in Sweden a pivot to easier policy as some of the inflation trends started to look more favorable. Now, we are going to get more details from the Bank of Canada's senior team members at a news conference at 10:30 Eastern Time in Ottawa. David Wolf still with us here. David, if I look at the time between now and the next interest rate decision in July, a few data points that we'll be getting ready for, 2 more reports for inflation, a jobs report, some numbers on the retail picture, and the release of April's official GDP data. Now, the officials seem to say that the focus is going to be on demand and supply in the economy, coupled with inflation expectations, what's happening with wage growth activity, what corporations are up to. But at the end of the day, what's the best recipe to be watching for if people are hearing this news today that there's a Bank of Canada cut? There could be more ahead, but we're not quite sure. What are the data points you would be watching most closely?
Right. So first of all, it's all of it. And I wish there was an easier answer than that. But the bank is looking, in terms of the pace and timing of further easing, at the extent to which inflation is likely to remain under control and how the balance of supply and demand in the economy is feeding into that. And that includes everything. It includes the rate of growth. It includes what we've already seen on prices. What they're trying to do is project forward a path that's going to get inflation to and then remain at 2%, and it's basically everything that feeds into that. But one thing I would caution, and I talk about this a lot with colleagues and others, not to get too caught up in the next interest rate announcement. That's certainly true for us, and I think that's true for investors generally. If you have anything but a really short investment horizon, does it really matter if they go today or they go in July or September or what have you? What you want to get right, and what we're focused on getting right, is the broad path of policy, both outright and how it compares to, 1, the U.S., and 2, what markets are pricing in already. And our perspective on that is markets are not pricing enough of a divergence between Canadian U.S. rates going down and U.S. rates probably not going down much, if at all. And that, we think, is going to have pretty significant consequences for the Canadian dollar. Seeing a bit of it this morning, we could see a lot more to come.
Maybe our control room can show what's happening with the loonie, which went to session lows after we got this decision. And for those who are just joining us, a quick reminder here, the Bank of Canada cutting interest rates by a quarter of a percentage point. The first time they've cut rates in 4 years. Remember back in 2020 when we were dealing with those pandemic realities, we saw 3 cuts in March of 2020. Then obviously, there was a long pause before the hike cycle began. Some criticized the bank for missing the inflation story. But David, if we're looking at the loonie right now below 73 cents, where do you think it's headed? And I guess a quick follow to that, some have been worried that we would import U.S. inflation, just the math of a weaker currency against the American currency. And if we buy a lot of stuff from the U.S., does that mean the inflation problem comes back and creates more challenges for us?
Right. So let me treat both of those. First of all, in terms of where the currency is going. So we don't have an official forecast. I personally think forecasting exchange rates in terms of point estimate and timing is basically a mug's game. But generally speaking, I think that there's quite a bit of scope to fall, and I'm on record, and you and I have talked about this years ago, that given where the economy is versus the U.S., and given the rebalancing that needs to be done domestically from domestic demand to foreign demand, it would not surprise me to see in the fullness of time a currency against the U.S. dollar that at least tests the lows that we saw in 2002, which is quite a bit south of here, as you know. With respect to the impact of the currency on inflation, I think that's misunderstood, which is to say the balance, it's a level shift, right? So unless the currency goes down forever, the bank will look through those inflationary effects. It's the effect on the economy that's more important.
David, really